Welcome to the deep dive. Today we're digging into YS Bank's numbers for the fourth quarter and the full fiscal year ending March 31st, 2025.
Right. And we've got quite a bit to go through: the official exchange filings, audited reports, the press release.
The strategy docs, asset quality updates, even some bits from the earnings call. Yeah, a whole stack.
So the mission, as always, is to pull out the key stuff. What does it all mean for the bank? Where it stands and where it's headed.
Exactly. And looking through it all, there seems to be a pretty clear theme emerging, wouldn't you say?
Definitely. It's all about profitability, strengthening that core business, and really getting a handle on asset quality,
Yeah.
especially after, well, everything they've been through with the restructuring.
Hmm.
That just keeps coming up.
Makes sense. So here's how we'll tackle it. We'll start with the main financial figures, Q4 and the full year. Then we'll look at the different parts of the business,
Asset quality is crucial, so we'll spend some time there.
for sure. And the deposits, lending, and finally their strategy and what they're saying about the future, all based on the documents we have in front of us.
Sounds like a plan.
Okay, let's jump in. Those headline numbers, they look pretty positive at first glance,
They
right?
really do. The net profit number is quite striking. For Q4 FY25, it's 246 crore. That's up, what, 92.3% compared to last year?
Wow, 92.3%.
Yeah, and they mention it's their best net profit since March 2020. And for the full year, FY25, same story, 2,406 crore, also up 92.3% year on year.
So consistent growth then. That's a strong signal.
It really signals some positive momentum, yeah, in terms of
Okay.
profitability.
And it's not just the absolute profit number, is it? The key ratios are improving too, like return on assets.
Exactly. ROA for the full year FY25 climbed to 0.6%. That was up from 0.3% the year before.
Well done.
And if you just look at Q4, it edged up even more to 0.7%. It shows they're getting, more efficient at making money from their assets.
Which investors definitely like to see. And what about the net interest margin, the NM? That's core to their lending business.
Right, the NIM, it was pretty stable at 2.4% for the full year. There was a small increase in Q4, up to 2.5%.
Stable is good in this environment, I suppose.
It is, yeah. Considering interest rate movements, holding steady or slightly improving there suggests they're managing their lending and borrowing costs pretty effectively.
Okay, so what's driving this profit boost? Is it mainly the core lending income, the NII?
Well, NII did grow. It hit 2,276 crore in Q4, which is up 5.7% year on year. And for the full year, 8,944 crore, up 10.5%. So decent growth there.
But not the full picture.
Not entirely. Their non-interest income, think fees, commissions, that sort of thing, that also had a really strong showing.
Okay.
It reached 1,739 crore in Q4, up almost 11% year on year. And for the full year, 5,857 crore, which is a jump of 14.5%.
So they're diversifying their income streams beyond just interest. That's healthy.
Exactly. And you see that reflected in the operating profit, too. Big jump in Q4 euro, 1,314 crore. That's up over 45% year on year.
45%, wow.
And for the full year, 4,254 crore, still a very healthy 25.6% growth. So, yeah, better operational efficiency, better profit across the board.
Okay, that paints a pretty positive picture on the earnings front.
Right.
But as you mentioned, asset quality has been the elephant in the room for Wise Bank historically. What are the sources telling us now?
Right, and this is another area where, honestly, the reports show some real progress. The gross non-performing assets, the GNPA,
Yeah.
it's down to 1.6%, which, again, they highlight as the lowest it's been since March 2020.
1.6%. That's a significant improvement from where they were.
It really is. And maybe even more telling is the net NPA, the NNPA. That's down significantly to just 0.3%.
0.3. Okay, that's very low. How do they manage that?
Well, a few things. They've been quite active on recoveries and upgrades from bad loans. They pulled in 5,923 crore in FY25 from that.
Which was better than they expected.
Yeah, they said it exceeded their own guidance. And another big move, they've basically dealt with those legacy security receipts, the SRs.
Ah, the SRs. Right.
They've brought the net carrying value down to zero, made a 100% provision against them.
So essentially, written them off the main books, cleaning up the balance sheet.
Exactly. It cleans things up, removes that potential drag, lets them focus on healthier assets going forward.
Makes sense. And are fewer new loans going bad? What about the slippage ratio?
That's also looking better. The gross slippage ratio came down to 2.1% in FY25. It was 2.3% the year before. So the inflow of new NPAs is slowing.
Okay.
And they also mentioned that the pile of restructured loans had dropped quite sharply, mostly due to repayments, including apparently a big refinancing in the hospital sector.
So even some of the previously stressed stuff is getting resolved.
Seems like it. So yeah, cleaner book, slower new problems forming. It looks like they've definitely made progress on shoring up that balance sheet.
Okay, definite strides on asset quality then. So with that looking healthier, let's pivot to the core business funding and lending. How are deposits looking?
Deposits are growing steadily. Total deposits are up 6.8% year on year, reaching 2,084,525 crore.
Okay, steady growth. But the key is always the cost of those deposits, right?
Yeah.
What about the say-SR ratio?
That's the really interesting part here. The CSA ratio, current accounts, savings accounts, it saw a big improvement, jumped to 34.3%.
Up from,
From 30.9% the previous year. It's a pretty significant shift towards lower cost
yeah,
funds.
that directly helps their margins. Are they actively chasing those kinds of deposits?
Seems so. They mentioned adding about 1.3 million new retail CASA accounts during the year, so clear focus on getting those granular, sticky deposits.
And the overall cost of deposits, has that come down?
It's been fairly stable, actually, around 6% for the last, I think, 6 quarters, but they do expect it to improve further.
Why is that?
They recently cut rates on their savings accounts just after the reporting period ended, actually. It's a tiered system based on balance now, so that should help bring the costs down going forward.
Got it. Lower funding costs, better ending potential. Okay, now the other side, lending. What's happening with advances?
Net advances grew 8.1% year on year, reached 2,046,188 crore. But the story here seems to be more about profitable growth, not just volume.
How so?
Well, they highlighted a big shift in the mix. Retail and SME loans now make up about 60% of their total advances,
60%. Wow, that's up
from just 36% back in March 2020. So a major rebalancing towards, potentially higher yielding segments.
right, away from maybe some of the larger, lower margin corporate loans, perhaps. Which specific segments are driving that growth?
The report points to SME and mid-corporate showing really strong growth, up 23.6% and 21.8% year on year, respectively.
Okay, so focusing on those mid-market businesses.
Seems like it. And looking ahead, management's actually targeting 12-15% overall loan growth in the near term, so they're fairly bullish on expansion there.
12 to 15%. Ambitious. Okay, so we've hit the financials, asset quality, deposits, lending. What about the bigger picture? Strategy, future plans?
Yeah, their strategy seems pretty well aligned with the numbers we're seeing. The roadmap to better profitability focuses on a few key things.
Yeah.
Reducing deposit costs, which we just talked about, expanding non-interest income again, we saw that growth, driving cost efficiencies, especially using digital tech, and of course, continuing to bring down credit costs.
Right, the digital push seems quite central.
Absolutely. They talk a lot about their leadership in digital payments, UPI, APS, NEFT, NEST, all those. And they've launched new apps, Iris for retail and Iris Business for businesses.
And is it working? Are they getting traction digitally?
Apparently so. They mentioned a high percentage of new savings, and current accounts are now sourced digitally, so it seems to be helping customer acquisition and efficiency.
But they're not abandoning branches, are they? I saw they added some.
No, not at all. They actually called branches the fulcrum for their business, especially for getting those CASA deposits and, building relationships. They added 37 new branches in FY25, mainly in areas they think are rich in CASA potential.
Interesting. That blend of digital and physical.
Yeah.
What else stood out strategically?
Well, they made a point about their ESG recognition. Apparently, S&P Global and CDP rated them highest among Indian banks on ESG and climate stuff for the third year running.
Okay.
And they got the government nod to collect taxes, direct and indirect. GST is live, others are coming. That could be a decent fee income source down the line.
Right. And capital. Do they have enough firepower for this growth?
They seem to think so for now.
Ah.
CET1 ratio is 13.5%. Total capital adequacy is 15.6%. They said it's sufficient for current plans, but they'll look at options if bigger opportunities come up.
Okay. And longer-term targets, what are they aiming for?
They're aiming pretty high. One ROA over 1% by FY27, and then 1.5% by FY29 or FY30.
1.5% ROA.
Mm.
That's quite ambitious. How do they get there?
Primarily through NIM expansion, it seems. They're targeting a NIM of 3.2% to 3.5% or even higher. That's a big jump from the current 2.5%.
That'll require significant progress on both funding costs and lending yields.
No doubt. And related to efficiency, they mentioned a recent restructuring too, merging some retail liability teams into branch banking, consolidating SME and mid-corporate under commercial banking.
Streamlining things.
Yeah, trying to improve efficiency and customer outreach. They also noted some layoffs in retail assets were part of this bigger consolidation effort for their future plans.
Okay, a lot happening on the strategic front then. Now, something listeners often ask about, related party transactions.
Yeah.
Anything significant disclosed?
They provided the standard disclosures for the second half of FY25.
Mm-hmm.
Quite a few transactions listed with State Bank of India investing, Treasury, fund-based, non-fund-based stuff. Makes sense given SBI's role.
Sure.
Also, ongoing dealings with their subsidiary. Akia Securities, income from them, brokerage paid to them, sharing expenses.
Yep.
Pretty standard subsidiary stuff. And then the usual disclosures deposits held by directors, their relatives, key managers, and a service fee paid to one director acting as an expert member. It's all about transparency there.
Good to have that transparency. Okay, nearly wrapped up. 2 final points. The auditor's view and that ongoing AT1 bond issue. What's the verdict from the auditors?
Clean bill of health, essentially. The joint auditors, GM Kapadia & Co. and C&K and Associates, gave an unmodified opinion on both the standalone and consolidated results for FY25.
Unmodified. So no major issues found with the accounting.
Correct. It means they found the financials present a true and fair view, basically.
Okay, and the AT1 bonds. That saga continues, right?
It does. The legal challenges from the bondholders who got wiped out in 2020 are still ongoing. Yes Bank's position hasn't changed. They believe, based on regulations, there shouldn't be a material financial hit.
And the RBI and government are involved too.
Yeah, they're also challenging the Bombay High Court judgment that went against the write-down. The whole thing is tentatively scheduled for a Supreme Court hearing on July 24th, 2025.
So still uncertain. Definitely something to keep an eye on.
For sure.
All right, well, that brings us towards the end of this deep dive into Yes Bank's latest results.
Yeah, I think to sum it up, FY25 really looks like a story of significant turnaround. You see clear improvements in profit, a much healthier asset quality picture, and that stronger SEXA base.
Their strategy focusing on digital granular deposits, costs, it seems to be paying off, at least based on these numbers.
Right. They sound pretty optimistic about hitting those future targets, growth, profitability. They always add that caveat about watching the broader economy.
Of course. So hopefully you listening now have a clearer picture of Yes Bank's performance and where they're trying to head based on all the documents we went through. That consistent theme of fixing the fundamentals and looking forward is pretty clear.
Definitely. And maybe a final thought to leave with everyone. Considering those ambitious ROA targets, especially that 1.5% goal, and how much they seem to be banking on NIM expansion, in an interest rate environment that could still shift, what factors do people think will be most critical for Yes Bank? For them to actually navigate the next few years and hit those targets? Is it cost control, loan growth quality, the rate cycle itself?
That's a good question. Might push you to look more closely at banking trends, rates, and how Yes Bank stacks up against competitors. Something to chew on.